it's a defensive hedging strategy. You don't use zone recovery to make money. You use the entry, the simple trade setup, the entry setup to make money. That's what makes you money. But zone recovery is defense, when everything and the kitchen sink go against you. That's how you get out of a bad trade. It's a defensive hedging strategy. In other words, opening a trade in the opposite direction of the original trade, based on a mathematical formula, also called algo or algorithm, algo trading. You've heard that, right? Who uses that? Who else? The guys with money, because they know they're not as smart, as fast as a computer can be, right? Which eliminates trading losses altogether every time, 100% of the time, when set up properly. Now, what it does, it literally turns every losing trade into a profitable trading sequence. In worst case, break even. Unless, of course, the markets completely stop moving. Now, if the markets were to stop moving and they say, okay, this is it, we have no more trading, everybody go home, then we've got nothing to talk about, right? All right. This is, ladies and gentlemen, this is a big deal. This is life-changing. It is earth-shattering. It sets up, in my mind, in my opinion, a completely new way of trading, a new paradigm in trading as we know it. And I'm the one to bring it to you. All right, so here we are. Let's assume this is our trade setup. Price is here. That's the current price. Now, where do you think the market's going to go based on this? We don't know, and for this illustration, we don't really care. That's not important. If you do your setups right, you will be right 75% of the time. Now we're only going to talk about the rest of the time. Now, we could say that the market is going to go up. This could be a long trade setup, right? Now, if we're right, this is going to be our target. Now, the market, though, could be going this way, could be going down. See, we don't, from this point forward, from here, we don't know yet. See, what really blows me is when, I listen to these teachers that probably have never traded in their lifetime, and they're showing a chart, and, oh, this is, you go in here, this is where you take the profit, you go in there, this is where you take the profit, but they don't trade. They only do this with the benefit of hindsight. Now, we don't have hindsight when we trade. We have a blank canvas. We don't know what's going to happen. The market can go up. We have a target. We want to make money. Or the market can go down. Then we'd have this target. Right? Now, you will become an excellent trader when you make money as long as any one of these targets get hit. Now, and I will argue with you that no matter what this price is, sooner or later, I don't know when, and I don't know which one will come first, but I know in time the price will be either here or either there. Right? The market will either go up or go down. That is one thing I know for certainty. I may not know when, it will hit down here or up here. And I may not know which one will hit first. I also know this. It will not happen at the same time. It will be one or the other. Now, and I present to you that I will make money as long as one of those targets get hit, regardless of which one it is first. Doesn't matter. Right? Here's how it's going to happen. Here's the price. And we're trading euro dollar now, 2.950. This is from a couple of days ago. Now, let's assume that our setup is to the upside. Right? So we're going to place a long trade, one lot. Let's assume we're trading 5 lots, so this is our initial 1/5, right? And this is going to be our target, long target, 150 pips. We're going to try to hit 131. Well, we're going to try to. We're hoping to. We're not going to affect the market, but now, if we are right, obviously, we're going to hit the target. But let's assume we might be partially right, or we might be completely wrong, but we don't hit that target yet. The market goes the other direction. Well, if the market goes the other direction, it will go down. We have a long trade. What do we do now? Well, we will get to a point where we're X number of pips, and let's just call it, for the sake of illustration, when we're 50 pips underwater, or 50 pips in a loss on this particular trade, we will enter a short trade, a hedging trade, hedge trade, right? And with that trade, we're going to target profit on this trade, a short trade, 150 pips. And that price would be 127.50. Now, in order for us to do that, with this trade still open, we'd have to place a trade of 1.4 lots. Now, the key is, worst case, to break even. So stay with me here. I am 1 lot long at 125.50. If I happen to hit this target, I will be 200 pips short. I will be losing 200 pips on this one lot, correct? So I will be 200 pips down from 129.50 down to 127.50. Correct? True or false? True. But at the same time, on 1.4 lots, I will be up 150 pips. So you do the math for me. How much will I be up here? Anybody? 1.4 times 150? 210. So aggregate, I'll be what? 10 pips up. I'll close my entire sequence, which started off with a long trade. I'll close the sequence on my recovery target with a 10 pip profit, even though the market went against me. Now, easier said than done, right? Well, suppose the market reverses, goes back up again, doesn't hit my target. Well, not what I really want to have happen, but guess what? Right on the same, at the same entry point as I placed my initial 1 lot long trade, I'll place another long trade. And this time it will be another lot. So right at this point, I will have 1 + 1, 2 lots going up, and by the way, these are all open trades. I don't close any trades unless the whole sequence is in profit. That's what we established, right? So I got 1 plus 1 is 2 going up. If I hit this target, then I will have 2 lots in profit, 150 pips, which is what? Plus 300. Now I will have 1.4 lots, 200 pips down, which is what? Minus 280. So on my long recovery target, I'll close the entire position with a 20 pip profit. Now, if I hit it, if I hit here, guess what? I made profit. If I hit here, I made profit. Suppose, and basically what I have established, I have established my zone recovery area, which is the difference of my acceptable loss on the first original trade. What's my acceptable loss if the market goes against me? 100 pips, 200 pips, 50 pips. In this, for the sake of illustration, we made this 50, right? So that's my zone recovery area. And the way the zone recovery algorithm works is that it places long trades on the upper boundary and short trades on the lower or bottom boundary. So that if I don't hit this target and the market reverses and heads back, then I will place another trade down here at 1.4 lots. Now do the math with me. I have 2 lots. If I hit this area, if I hit this target, 2 lots, each of them 200 pips down. That's minus what? Minus 400. But I have 1.4 plus 1.4, that's 2.8. In profit, 150 times 2.8 is what? 420? Right? So if I hit this area or hit this target, I what? I made 20 pips. Right? See, I don't know when or which one I'm going to hit first, but I'll tell you this. Sooner or later, I'll hit one. If I don't hit it this time, the market turns. Place a trade of 1.9. You add them up and you'll find out when you hit this area or when you hit this target, you'll be making money again. If it reverses, that will be 2.5 lots. You hit this target, you make money. So basically, it doesn't matter which direction the market is going, and doesn't matter which direction your original trade is. Sooner or later, it will hit a price above or below your entry. And when it does, you will clear the profit from the entire trading sequence. That way, you never have to take a loss. You don't have a stop loss. Zone recovery, in my opinion, is such an awesome strategy that you can even trade against the trend and still make money. Now, I don't recommend it, but if you can do it, how much better does it get? See, I don't sweat and try to figure out which direction the market is going to go anymore. It doesn't matter. I make money every time. Every time. Every time the sequence of trades closes, worst case, I've broken even. Everything else is profit. Now that's pretty good math, if you ask me, right? So when using zone recovery in the proper way, I'll show you. it is virtually impossible to lose money regardless of your order or market direction. So if you really think about this, everything you have learned up until this point, up until now, you can throw out the window because it won't matter anymore. It doesn't matter. We change it. There's a new paradigm. Now, let's look at it again. Current price. Let's assume the market's going up. We enter long, right here, the current price. If we're right, we make money here. That will happen 3 out of 4 times when you properly do your entry setups. If we're wrong, market reverses. If the market reverses, we enter short at the bottom of the zone recovery. If we're wrong, we make money here. All right, now, same thing. If we think market's going down, if we're right, we make money down here. If we're wrong, market's going up. We enter long here at the top of the zone recovery. Basically, the zone recovery is the set number of pips that your original trade goes in the red. That's it. Here's how your trading results should be. 3 out of 4 trades, you take profit because that's just good setup. 1 out of 4, worst case, break even. Now that to me is pretty good results. Right? So now how do you do these zone recoveries? Well, obviously this is easier said than done when trading manually. I mean, you can do it. You just calculate, have a little chart, and basically have your longs and shorts, and this is what's going to happen. Also, you have to sit there, and really, in the 21st century, I don't know very many successful traders that still trade manually. If you show me someone who trades manually, I'll show you someone who could be making a whole lot more money. Now, so for best trading results, you should always use automated trading software that will never miss a trading opportunity and will manage your trades 24 hours a day. Okay, I'll show you